Why does the entity that you choose matter? And I'm going to talk about taxes. I'm going to talk about asset protection, which is protecting your stuff. And I'm going to talk about funding and how, depending on the entity that you select, it's going to affect you. So when we go into taxes, right out the gate, we're going to scratch out sole proprietorship. Tax-wise, sole proprietorship is the absolute worst entity to have if you're buying businesses, and for the sellers that you're buying these businesses from. Sole proprietorship is the worst entity to have. Why? Because tax-wise, you are the business. And so when it comes to any revenue that you make in that business, when you're a sole proprietorship, it's going direct. You're giving the IRS a lightning bolt to your personal bank account. The thing of it is, when it comes to businesses fail every day, right? The reason why we're looking at buying an existing business is because we want to kind of mitigate the failure rate, right? We want to make it harder for us to fail. So by buying a business that already has systems and stuff in place, it'll be harder for us to fail. But sometimes after buying an existing business, those businesses still fail, right? But if you take out debt and you're operating in a sole proprietorship, you can file for bankruptcy and those debts will disappear. Well, guess what type of debt you can't get rid of? Tax debt, IRS debt. You cannot bankrupt out of IRS debt. So a sole proprietorship, it doesn't make sense to buy your businesses in that regard, right? There are no redeeming qualities for sole proprietorships. They don't protect your assets. You are the business. You're likely to use judgments. Those lawsuits, they come directly to your desk. When we talk about business credit, it goes to your Social Security number, and then there's a limit on the amount that you can borrow based on your debt to income ratio. So partnership is pretty much 2 or more sole proprietors. So again, when we're talking about a partnership, it's you and your buddy. You guys just go into business, no formal structure. Tax-wise, it's going to both of your Social Security numbers. If the business fails, if the business gets sued, whatever happens, you can't get rid of that IRS debt. That's going to follow you forever. So out the gate, tax-wise, there's no benefits for a partnership, no benefits for proprietorship, and that's why we X them out. So now that leaves us with C-Corp, S-Corp, LLC. And we're going to go through a little scenario. Let's say a business did $1 million in top line sales and it had left over after paying all the bills. There was $100,000 left in EBITDA. EBITDA, you'll hear this term thrown around. It stands for earning before interest, taxes, depreciation, and amortization, right? Yep. Big fancy word for pre-tax profit, right? That's all it is. It's your profit at the end of the day, pre-tax profit. All right. Some people will try to say, oh, it's not net profit. And, at the end of the day, whenever someone's making reference to EBITDA, they are making reference to your profit after you pay all your bills, right? Pre-tax profit. And so what we're going to do is we're going to do a scenario where we got 100 grand in profit running through these 3 entity types. And I'm going to show you how they kind of measure up, right? So when it comes to a C-Corp, right out the gate, C-Corp is charged right around the 21% tax rate. So C-Corp, you're going to pay corporate taxes right at 21%. That puts us, right at about 21 grand. And so that leaves us with 79 grand left over. S-Corp and C-Corp, S-Corp and LLC, they're not taxed at the corporate tax level. And so that's why you see that 0 right there for those 2 entities. They're not taxed at the corporate tax level. And so, you're still left with that 100 grand. This is where most attorneys, this is where most CPAs, accountants, they close the book and they tell you, see, this is why you need an S-Corp. This is why you need an LLC, because they don't get taxed at the corporate tax level. Well, the next question you should ask is, well, how do S Corps and LLCs get taxed? How do they get taxed? The way that those two entities get taxed is that income is passed through to your personal taxes.
Yeah.
S Corps and LLCs are what you call pass-through entities. Have you ever heard that term before? What they mean when they say pass-through entity is that that income is going to pass through to your personal tax return in the form of a K1, a Schedule K1, right? Most businesses, when someone, there's different ways for you to get taxed when you file your taxes, right? You have a job, you get at the end of the year, you get a W-2, right?
Yep.
For your job. If you are a freelancer, you will get something that's called a 1099.
Yeah.
Are you familiar with 1099s?
Yep.
Right? A K1 is just like a 1099.
Gotcha.
So if you've ever received a 1099, you know that when you get a 1099, it just reports the income, and then you have to pay taxes on that reported income.
Yeah.
Right?
Right. Yep.
So like if you had a W-2, for 50 grand, and you had a 1099 for 100 grand, should you expect to get a tax return refund when you file your taxes, or you think you're going to owe money? More than likely you're going to owe. More than likely you're going to owe. And that's why people don't really like 1099s, because you're going to owe when it comes to getting your tax refund. Well, a Schedule K1 is the same exact thing.
Gotcha. So
at the C-Corp level, the C-Corp paid 21 grand in taxes, and there's 79 grand left in profit. But this has nothing to do with you personally at this point. The corporation just paid the taxes. It did the heavy lifting, and you are off into the sunset to use that money for reinvesting into the business or whatever else you decide to do. With an S Corp and an LLC, it doesn't matter what you do. That 100K is passing through in the form of a K1 to your personal tax return. Right? And you can't bankrupt that money away. You can't bankrupt it away, right? And so the next question is, when it comes to the C Corp, how do you personally get money out, right? Well, that 79 grand, the way that people typically pull money out of a business is to either A, pay themselves as a W-2 employee, or B, pull money out in something that's called a draw, right? An owner's draw. When it comes to C Corps, it's not called an owner draw. It's called dividends, okay? It's called dividends. And so you get taxed 15% on whatever you take out after this 79 grand with the C Corp, right? So that's after you've already paid yourself as a W-2. If you don't want to get taxed at 15%, then just don't declare dividends. It's really that simple, right? If you don't want to get taxed at an additional 15%, don't take dividends. Don't pull any money out of the business bank account for personal uses.
Okay.
Does that make sense? It's really that simple. And another thing that I didn't mention is when it comes to this 79 grand that's left over, well, even before we even get to 70 grand, there's 100 grand that's left over. Before we even got to this 100 grand, you already paid yourself a salary as a W-2 employee. You understand? So if you've already paid yourself as a W-2 employee, there's no point in pulling out any additional cash out of the business. It really doesn't make any sense. So the best structure, C Corp, pay yourself as a W-2 employee. You set up a payroll company and let the payroll company just pay you as an employee, and you're good. Another benefit of C Corps is that they have something that's called carry forward loss. And what carry forward loss means, let's say the business, instead of having 79 grand left over or 100 grand left over at the end of the year, let's say that the business only had, let's say the business had negative 10 grand. And you're going to see that when you start looking at businesses. Let's say the business had negative 10 grand after paying all its expenses at the end of the year. Well, if it had negative 10 grand with a C-Corp, you can carry forward that loss to the next fiscal year. Okay? You can carry forward that loss. So if it was negative 10 grand, you could carry that forward to the next fiscal year, which will take away from the amount of taxes you would have to pay. And you can do that with the C-Corp to make your tax bill lower. Okay? S-Corps, we talked about it before, right? They have a K-1 that passes through to your personal tax return. You use it or lose it, so there's no carry forward loss. If you had a loss at the end of the year, you can't pass that forward to the next tax year to make your tax bill lower. You got to either use it that year or that's it. In addition to that, with an S-Corp, you're more likely to get audited in the early part of the year, right? You're more likely to get audited. And the reason why is because you can't file your personal taxes until the business taxes are filed. Because remember, with an S-Corp, you're getting something that's called a Schedule K-1, okay? And so you don't get that K-1 until you file your business taxes. And so now, as a result of that, more than likely, you're going to file your business taxes at the beginning of the year at the same time that everybody else is filing their taxes. And so that's when the IRS likes to do their audits. That's when they like to pick people at random to audit, because there's a lot of people filing their taxes at that time. And so when you have an S-Corp, you're more likely to get audited because you're filing around the same time as everybody else. In addition to that, you're competing when it comes to your CPA or your accountant. You are literally competing with everybody else. Your accountant doesn't have time to answer, simple questions that you may have about your taxes, because not only is he filing business taxes for everyone else that has an S-Corp or an LLC at that time, but your accountant is also filing taxes for the regular people that are just filing their tax. So like, if you just imagine trying to get a hold of your accountant at the beginning of the year, it's damn near impossible. It's the busiest time of their year. And so with an S-Corp and also with an LLC, you're kind of just screwed in that regard, because you're competing with everyone else. And so that's why I don't like those two entities regarding taxes. Another thing to note about LLCs, because if you notice the same things, the K1, you get a Schedule K1 with an LLC, you use it or lose it, no carry forward loss, more like the audit because you're filing at the beginning of the year. You can't file your personal taxes until the business tax are filed. But most importantly, LLCs are considered disregarded entities by the IRS. The IRS does not recognize LLCs. Everybody tells you to go out and get an LLC, but they don't know this. That they're IRS. If you go to if I pull up the IRS website right now, it literally says in bold print, the IRS doesn't recognize LLCs. And that's why whenever someone that has an LLC decides to file their taxes, their accountant asks them, do you want to file your taxes as a corporation or do you want to file it as a partnership? Because the IRS doesn't recognize it. One huge problem with these S-Corps versus with the LLC is this right here, right? Yeah. Let's just say you got married, okay? Let's say you got married. You bought a business. The business is doing $1 million in sales, $100,000 in profit, okay? And let's just say you had an LLC, all right? Your wife, she works a job. Let's say she works for the state. She works a job working for the state, making 60 grand a year. At the end of the year, at the beginning of the year, your wife is super excited because she knows that when she files taxes, you know, with her $60,000 a year salary, she's going to get a nice tax refund. So she's excited about that.
Yeah.
Now you own a business, and your business is an LLC. So before you can even know how much, if you're going to get a refund or not, you take your P&Ls, your profit and loss statements, your QuickBooks files, you take them over to your accountant, give them all your receipts and all that. He says, hey, congratulations. I calculated the numbers. You did $1 million in top line sales. You did $100,000 in profit. Now you are looking at your bank account, because remember, he's compiling this at the end of based off of the numbers that you gave them for the full fiscal year from January to December. So in January, you've already by the time the next January rolls around, it's time for you to start filing your taxes. You may have paid some bills, paid some credit cards, some business credit cards down. You may have bought some new equipment, and so you're looking at your company's bank account, and the company bank account may only have like 5 or 10 grand in it, right? But your accountant says, hey, you made 100 grand last year. Here's your tax bill. And that 100 grand is going to be in the form of a K-1 that's going to go to your personal tax return. So now, instead of your wife who's filing her taxes and she's excited for this tax refund to come back for 50 grand, you guys being in that 50 grand tax bracket, now you guys are in the $150,000 tax bracket. Okay? And not only are you in the $150,000 tax bracket, but you don't even have any money to pay for it. Because you spent most of the money in the business. That's the problem with an LLC and with an S-Corp. Doesn't matter. It doesn't matter if you spent the money or not. It's going to your personal taxes, and it's going to push you through a higher tax bracket. Gotcha. With a C-Corp, you could pay yourself. Your wife has a $60,000 W-2 job. In a C-Corp, you can pay yourself out of the money before it even hits the 100 grand, right? The business did $1 million in sales. Before it even hit this, you already paid yourself a $40,000 salary, a $50,000 salary that you're getting the W-2 for. Okay?
Yeah.
The corporation is paying that 21 grand. It's not coming to you personally. So at the end of the year, when the company gets its tax bill, it's going to be paying its tax bill out of that money that's left over versus it coming to you personally. The C-Corp is really the best entity class. And what I want to say is a lot of times people, when they start a business, they'll talk to their accountant, they'll talk to their attorney. And I've had attorneys and accountants review this information that I'm sharing with you, and they agree wholeheartedly. Most accountants and most attorneys, when they are recommending an entity to you, they're doing it not based off of experience. Most lawyers and most CPAs, they don't even have LLCs and corporations. They have professional entities. They don't even have these type of entity classes. So they're not telling you which entity to select based off of their personal experience. They're telling you the entity to select based off of what they learned in college from a textbook. Okay? I'm giving you information based off of experience. And so you'll find a lot of times these accountants, these attorneys, they'll say, oh yeah, when you start your business, just start it as an LLC. And once you start making money, you can convert it to a C-Corp. In reality, you cannot legally convert an LLC to a C-Corp. That is impossible. You cannot do that. Okay? You may hear people say that you can convert an LLC to a C-Corp, but you cannot do that. It's impossible because the LLC has, when you create your LLC, it's going to be issued an EIN number, right? That's in essence the social security number for that for the LLC. And when you create a C-Corp, it's going to be issued its own EIN, right? So you can't convert that LLC, that EIN for the LLC to an EIN for a C-Corp. They're completely separate entities.
Yeah.
So when someone is saying, if you hear people saying, oh yeah, you can just convert the LLC to a C-Corp, the process in which they are making reference to is you have to actually dissolve the LLC and create a new entity with maybe the same name. And so the problem with that is that LLC, if you've been doing business in it for a year or 2 years and you made enough money where you're ready to transfer it over to a C-Corp, that LLC is going to have contracts with other businesses. That LLC is going to have credit. But in order for you to convert it, you're going to have to dissolve it and create a whole nother entity. And that new entity that you create is not going to have the same contracts. Those contracts were not with this new corporation that you're creating. Those contracts were with that LLC. The business credit that you get is not going to be with the new corporation you're creating. It's going to be with the LLC. And so you're going to lose all that history, right? And so you can't convert, legally, you can't convert an LLC to a C-Corp. You have to dissolve that entity and create another one. So if the plan is for you to eventually go from an LLC to a C-Corp, why not just start out with the C-Corp? You know what I'm saying? It just doesn't make sense. And I don't know why attorneys recommend that to people. I don't know why CPAs recommend that to people. It makes no sense, right? Disney, Amazon, ESPN, all these companies, what are they? They're corporations. And the reason why is because from a tax viewpoint, corporations are the best way to protect yourself.